Good morning, everyone, and welcome. I call this meeting of the NCUA Board to order. I want to note for the record that due to the COVID-19 pandemic, today's meeting is open to the public through a live webcast only. The public may access the meeting by visiting the agency's homepage at www.ncua.gov and clicking on the provided webcast link. Additionally, presenters in today's webcast meeting are participating remotely. So if we experience any technical difficulties, I ask for your patience. Please note that for our open board meeting today, the audience will not only see and hear the NCUA board members on camera, but they will also see and hear the presenters on camera as well, instead of just hearing them on the phone. You may also change the layout to one of your choosing by clicking on the layout option on the top right corner of the video. Our recommended view for this meeting is the stack view. Lastly, if you would like to view the live closed captioning, please click on the panel labeled Multimedia Viewer located in the bottom right of the screen. Additionally, our proceedings today will be a bit different in that we will have several short breaks during the meeting to change panels and presenters. These breaks will last about 3 to 5 minutes, and we will take them approximately every 30 minutes. Before we get started with the formal agenda today, my fellow board members and I have several announcements. I will begin. On February 24th, the war returned to the European continent when the Russian Federation launched a full-scale invasion of the sovereign nation of Ukraine. We at the NCUA stand united with the Ukrainian people in support of their desire for freedom, democracy, and independence. We stand in support of the Ukrainian people living in the United States who fear for the welfare of loved ones and the future of their native land. And we stand with credit unions that provide safe, fair, and affordable financial products and services to Ukrainian communities across our country. Unfortunately, today's interconnected financial system means the war in Ukraine has far-reaching implications beyond its borders. The conflict has raised concerns about the potential for imminent attacks here in the United States, including those against the financial services sector. Recently, the NCUA circulated a cybersecurity alert from the Department of Homeland Security, the FBI, and the National Security Agency. I cannot stress this enough. All credit unions and vendors, regardless of size, are potential targets for cyber attacks and must remain vigilant. They should also report any cyber incidents to the NCUA, the FBI, and the Cybersecurity and Infrastructure Security Agency. Accordingly, I encourage all credit unions to download and use the NCUA's Automated Cybersecurity Evaluation Toolbox, or ACET for short. This tool is an excellent resource, especially for small credit unions or credit unions with limited resources, to help them understand their cybersecurity preparedness levels. The ACET is available at no cost, and credit unions can find the tool on the NCUA's website at www.ncua.gov/cybersecurity. Unfortunately, the potential for cyber attacks is not our only challenge. Yesterday, March 16th, marked a somber occasion, the second anniversary of the NCUA working remotely because of the COVID-19 pandemic. As the pandemic has unfolded, many employees likely thought we would be back in the office or on the road in a few weeks. Few of us expected to be working remotely 1 year later, and none of us expected we would mark our second year working remotely because of this global scourge. That, however, is our reality. On behalf of the NCUA board and the agency's entire leadership team, I want to express my profound gratitude to the NCUA's more than 1,100 employees for their dedication, resilience, and patience, as well as their good humor during the last 2 years. Despite every obstacle, all of you performed brilliantly and continued to carry out the NCUA's safety and soundness, consumer protection, and financial stability missions. And to those of you working at federally insured credit unions across the country, thank you as well for your work supporting your members and communities. You have been America's financial first responders. As we enter the pandemic's third year, it is time to think creatively about what we all, the NCUA and leaders of the credit union system, can do to positively shape the credit union industry's future. Let us work together to make meaningful and positive changes. I look forward to working with my fellow board members and other stakeholders to make this vision a reality. And I look forward to returning to the office and having in-person NCUA board meetings in the coming months, circumstances permitting. That concludes my remarks. Mr. Chairman, I understand that you have a statement as well.
Hi there. You bet. I just want to talk about Congress passed a bill recently, and we were all disappointed here to learn that the Central Liquidity Facility enhancements outlining the CARES Act did not make it into the Consolidated Appropriations Bill. I'm committed, as are my fellow board members, to continue our efforts with Congress to make those changes permanent. I understand that the CLF is a rarely used utility, but that's how it should be. We wouldn't say, my house hasn't burned down in the last 10 years, so I don't need fire department anymore. In the event of a financial crisis, I'm mostly concerned with the 3,648 small credit unions, including minority depository institutions, that will lose access to the $13 billion in on-demand emergency liquidity if the CLF enhancements are not made permanent. Thousands of small credit unions and millions of members are at risk. In addition, without the enhancements, the CLF's ability to provide rapid emergency liquidity to the Share Insurance Fund is substantially reduced, which puts the credit union movement at risk. Increasing access to the emergency liquidity provided through the CLF not only reduces risk to credit unions, it also comes at no net cost to the taxpayer. In addition, the agency relationship with the corporate credit union system saves the NCUA substantial resources, and more importantly, it saves us precious time during an emergency. But given the situation is what it is, it's not a bad time to mention that credit union management and no one else is ultimately responsible for their liquidity needs. But as someone who was a Lehman Brothers employee when they collapsed in 2008, I pray we never have another financial crisis like that one, but we must be prepared. Thank you, Mr. Chairman. I appreciate the opportunity to address this issue. Back to you.
And I just want to echo, I wholeheartedly support what we need to do for the CLF. We stand united on this issue as a board. Board Member Hood, is there anything that you would like to say?
Yes, thank you, Mr. Chairman. I, much like yourself, sir, I do stand in solidarity with the Ukrainian community. I am lifting them up in my thoughts and prayers as they deal with this difficult situation. I would like to certainly call special attention to what our World Council of Credit Unions is doing to really provide leadership, support, financial fundraising activities, all to address some of the urgent matters that our Ukrainian credit union members need during this difficult time. So hats off to them. They've really embarked upon some very aggressive and ambitious fundraising goals, and I'm very proud to hear the progress that they're making each and every day. Like our Vice Chairman, I also believe in the significance and importance of our Central Liquidity Facility. It is critically important. It's not a question of if there will be another financial crisis, but when there will be one. 2 years ago this month, Congress temporarily enhanced the CLF's authorities. Those authorities were extended by Congress in the Consolidated Appropriations Act 2021 for another year. I would like to recognize Giselle Roget, who ran the Office of External Affairs and Communications when I was then chairman, for getting these provisions added into law in partnership with Owen Cole, who's since retired, Larry Fazio, and Anthony Capetta, who is now our CLF president. These changes were critical because it increased the borrowing authority of the CLF and temporarily relaxed the requirements on agent membership, making membership more economically feasible for corporate credit unions, which ensured that more natural person credit unions had access to the CLF. This change was especially critical because after the involuntary liquidation of US Central in 2010. So prior to US Central's involuntary liquidation, most natural person credit unions effectively had access to the CLF without the expense of a CLF subscription through US Central. Today, the credit union system is awash in capital and liquidity, but as I've said before, we should prepare for the worst and hope for the best. One of the best ways for NCUA to prepare for the best is to have a robust central liquidity facility. It is a profound disappointment that the CLF provisions were not extended in the Consolidated Appropriations Act to 2022. which was recently signed into law. Not having this tool really makes it difficult for us to prepare for the worst. And I want to agree with the statement that you made, Board Member Harper. This was 2 years ago, and I couldn't agree with you more. You made this statement at one of the meetings just days before the CLF provision was signed into the CARES Act. And I quote, "We cannot be asleep at the wheel as we need to bolster the credit union system during a time of crisis. Credit union members are counting on us to get this right. There are a handful of legislative vehicles responding to COVID-19, and these CLF changes could be part of one of those bills." 2 years later, Chairman Harper, I am certainly finding myself agreeing with you wholeheartedly under much different circumstances. In closing, while the CLF should be a lender of last resort, especially during times of crisis, we also need to revamp the system. We need to sit down with the corporates and natural person credit unions to create a cooperative facility that reflects the realities of today. Mr. Chairman, in that regard, I would reiterate, as I did in January, that we should require the NCUA board to be briefed on the status of the CLF at least once a year and make this corresponding change in our delegations of authority. Thank you, Mr. Chairman, for allowing this board to make individual statements today.
No, absolutely, Board Member Hood. And I do think we do need to recognize the important work that Giselle, as well as everybody in the OEAC team, did in putting together and helping to get the CLF temporary enhancements passed not just once, but ultimately extended. And we now are, of course, working to reinstate those authorities. I completely agree with you also on the need for CLF briefing at least once a year. I know that we're looking for sometimes this summer. We've just, of course, announced Anthony Capetta as the CLF president, a priority that you wanted to make sure that we had a more robust CLF operation. We wanted to give him just a little bit of time to put some things together and strategize so that we can have a better briefing for all of us, not just for us, but for the entire public and the credit union system. Let's now turn to our first item on the agenda, which is the NCUA's 2022 through 2026 strategic plan. Staff presenting are Melissa Loudon, Deputy Director, Office of the Chief Financial Officer, and Lindsay Courage, Management Analyst, Office of the Chief Financial Officer. Staff available for questions also includes Eugene Sheed, Chief Financial Officer. Good morning, Melissa and Lindsay. You may begin whenever you are ready.
Good morning, Chairman Harper, Vice Chairman Hoffman, and Board Member Hood. Lindsay and I are here today to request board approval of the 2022 to 2026 strategic plan, which includes the agency's enterprise-wide risk appetite statement. NCUA's planning and reporting conform to the Government Performance and Results Act, or GPRA, of 1993, the GPRA Modernization Act of 2010, and the Office of Management and Budget Circulars A11 and A123. The strategic plan is significant to the NCUA because it provides a roadmap for the direction and initiatives the agency plans to undertake over the next 5 years, both in response to and anticipation of ongoing changes in the financial sector and credit unions. In November 2021, the NCUA board approved a 60-day public comment period for the proposed 2022 to 2026 strategic plan. The public comment period for the strategic plan ended on January 24th, 2022. The NCUA received 15 comment letters. The comments were primarily focused around the following 4 areas. First, addressing climate-related financial risk, including ensuring the strategic plan does not discourage credit unions from serving specific industries such as agriculture. Commenters also suggested a collaborative approach with other regulators to develop a risk-based strategy for addressing climate-related financial risk. Second, adopting additional flexibilities for and reducing the burden of the examination program, including extending examination cycles in lower risk credit unions and implementing virtual examinations. Third, improving agency support for new credit union chartering and low income and minority depository institution designations, in part by streamlining agency processes. And fourth, opposition to statutory changes related to the Share Insurance Fund and encouragement for returning the normal operating level to 1.3%. Many of the comments received were generally supportive of the efforts and initiatives that NCUA has undertaken and that are included in the strategic plan. This includes general support for items such as using a hybrid approach of both on-site and virtual examinations, and for collecting feedback from stakeholders and credit unions to improve the examination process, improving the chartering process and continuing efforts to promote diversity and inclusive, equitable financial services at credit unions, and improving the skills and technical capabilities of the NCUA workforce. I will now turn it over to Lindsay to discuss the resulting changes we propose to the draft strategic plan and other details about the plan.
Thank you, Melissa. Good morning. As Melissa mentioned, we considered all the comments we received. Some comments suggested making more detailed commitments to specific programmatic outcomes than would be typical for a strategic plan. These comments will be referred to the appropriate office that manages program implementation or have been addressed in the 2022 Annual Performance Plan, which is on the agenda for your consideration later today. Based on the various comments received, the agency did revise the draft strategic plan. Specifically, the changes include revising the narrative describing the long-term risk posed by climate-related financial risk, adding additional strategies explaining the NCUA's support for small, minority, new, and low-income designated credit unions and underserved areas, revising a proposed strategy under Strategic Goal 2 to include other partnerships to the strategy supporting the success of small, minority, low-income designated, and new credit unions through training and CDRLF, Community Development Revolving Loan Fund, technical assistant grants and loans. The addition of a strategic objective in Goal 1 related to addressing opportunities and risks from emerging financial technology. Other modifications to the strategies and example performance goals to highlight priorities or for clarification. And lastly, updates to the economic outlook section to reflect current events and more recent data. The 3 strategic goals remain unchanged between the draft and this final strategic plan. The agency's 3 goals are to 1, ensure a safe, sound, and viable system of cooperative credit that protects consumers. Goal 2, improve the financial well-being of individuals and communities through access to affordable and equitable financial products and services. Goal 3, maximize organizational performance to enable mission success. The strategic plan also formalizes the risk appetite statement for the NCUA's Enterprise Risk Management Program. Our risk management framework helps agency leadership identify and evaluate specific risks and prioritize and mitigate risks on a continuous basis. The ERM program requires close collaboration across all agency functions and is intended to improve mission delivery. Guided by the NCUA's strategic goals and objectives and leadership priorities, the NCUA strategic plan defines the agency's overarching risk management philosophy. The statement in part reads as follows. NCUA is vigilant and has an overall judicious risk appetite. NCUA's primary goal is to ensure the safety and soundness of the credit union system, and the agency recognizes it is not desirable or practical to avoid all risk. Acceptance of some risk is often necessary to foster innovation and agility. This risk appetite will guide NCUA's actions to achieve its strategic objectives in support of our mission. The Enterprise Risk Appetite Statement serves as the foundation for ERM at NCUA. In combination with the strategic plan, the Risk Appetite Statement provides additional information for NCUA management and stakeholders on the agency's approach to achieving our goals and objectives. This concludes our presentation. We're happy to answer your questions.
Melissa and Lindsay, thank you so much for presenting the NCUA's 2022 through 2026 strategic plan to the board today. And my sincere thanks to both of you and the entire team of the Office of the Chief Financial Officer for your excellent work in developing and finalizing this plan. During the last few months, your team has been front and center on many projects, including the agency's budget, the annual audits of the agency's core funds, the development of the annual performance plan, and the drafting of the annual report. Thank you for your hard work. Over the last 4 years, federally insured credit unions have grown in both size and complexity, offering new products and services and facilitating financial transactions in an ever-growing digital and mobile space. What is more, the COVID-19 pandemic and its resulting financial and economic disruptions have accelerated many of these trends. As such, the NCUA must continue to evolve our examination program and administrative operations to ensure the fulfillment of our statutory obligations to maintain a safe and sound system where credit union members are protected. The NCUA must also continue expanding access to safe and affordable financial services, providing financial education, and closing the wealth gap. The NCUA developed this strategic plan through collaboration between board members and with input and coordination by the staff. The final strategic plan also incorporates the feedback and recommendations of stakeholders throughout the credit union system. Under this plan, the agency's 3 revised goals aim to: 1, ensure a safe, sound, and viable system of cooperative credit that protects consumers; 2, improve the financial well-being of individuals and communities through access to affordable and equitable financial products and services; and 3, maximize organizational performance to enable mission success. To meet our first strategic goal, we examine credit unions to ensure that they operate in a financially sound manner and comply with all laws and regulations, including those related to consumer financial protection and fair lending. This work ensures that consumers can confidently use credit unions for their financial needs, and businesses and communities have access to the credit needed to grow and thrive. As part of our second goal, the NCUA develops rules, regulations, and initiatives designed to expand access to fair, safe, and affordable financial products and services. This work includes chartering new credit unions, a priority for the vice chairman, and facilitating changes to credit unions' fields of membership, a priority for board member Hood. And this work fulfills the statutory mission of the credit union system, which is to meet the credit and savings needs of their members, especially those of modest means, a point I often emphasize in my speeches. Our third goal involves accomplishing our mission on behalf of the credit union members through teamwork. A critical part of that goal is to build a diverse and talented workforce and creating an inclusive environment where all employees have a sense of belonging and can bring their full and true selves to their work. Diversity, equity, and inclusion are priorities for the NCUA. With the implementation of this strategic plan, the mission and vision statements for the NCUA have become more inclusive of the agency's actual responsibilities and roles. Safety and soundness is not the only aspect of the NCUA's mission. The agency also protects consumers and credit union members. And this plan seeks to strengthen and advance financial inclusion, as well as economic equity and justice within communities of color, rural places, and underserved areas. Both board member Hood and I have often spoken about the need for the agency to do more in this area. Ultimately, at the core of the NCUA are the hardworking and dedicated employees, examiners, and executives who serve the public and credit union members. The NCUA team is essential to meeting the agency's continued success. Throughout the implementation of the strategic plan, the NCUA will work to recruit, train, develop a highly skilled and diverse workforce that is effective, innovative, and able to adapt to a continually changing financial services marketplace. While the future is filled with uncertainty, the strategic plan will guide the agency and the system in responding to any unexpected developments. The strategic plan will also assist us in addressing challenges and opportunities the credit union system may experience, including those related to emerging financial technology, a priority for Vice Chairman Hauptman and Board Member Hood, who have both pressed for this issue. The NCUA stands ready to meet all challenges head on and to seize those opportunities so that the agency and the credit union system may continue to evolve, innovate, and grow. In sum, our efforts to implement the 2022 to 2026 strategic plan will ensure that nearly 130 million Americans who place their hard-earned savings and financial dreams in the hands of our nation's system of cooperative credit are protected and able to utilize credit unions for many years to come. That concludes my remarks. Vice Chairman Hauptman, the floor is yours.
Thank you, Mr. Chairman, and thank you, Melissa and Lindsay, for the presentation, and to the Office of the CFO for pulling together input from the board, agency offices, and commentators. The NCUA's mission is to protect the system of cooperative credit and its member owners through effective chartering, supervision, regulation, and insurance. Our objectives continue to focus on safety and soundness, effective supervision, and improving the financial well-being of individuals and communities through access to affordable and equitable financial products and services. It's no secret that I believe that consumer choice is one of the best guarantees of consumer protection. Not only the choice of what type of financial institution to use, but also the choice to form a financial institution dedicated to the specific needs of its community, a credit union. The strategic plan and the associated annual performance plan continue to address the vulnerability of new and smaller credit unions. Work remains on clarifying and streamlining the chartering process for new credit unions. More resources have been directed toward small credit unions and minority deposit institutions. Regarding the plan's language around climate financial risk, the NCUA board wants to emphasize that nothing in the strategic plan should be construed as discouraging or encouraging more or less activities related to agriculture or fossil fuels. We add no value by informing credit unions in Florida that they have damaging hurricanes, nor those in agriculture that droughts are harmful. The agency does not intend to micromanage credit union lending decisions for climate financial risk, including lending to family farms and others in the ag sector, as well as businesses tied to the fossil fuel industry. Any micromanaging or putting NCUA's thumb on the scale may end up adding, not subtracting, risk to the SIF. Similarly, regarding membership affected by climate, credit unions, not the NCUA, are best positioned to assess various risks and opportunities within their field of membership. Credit unions need to make their own decisions on diversification and expanded fields of membership. The plan continues to recognize that credit unions must have access to evolving technologies to remain viable. Clear guidance and regulation that allow for innovation will allow credit unions to move forward confidently. Improving dialogue and transparency with credit unions remains an area of focus. Better communication, including exam feedback surveys, and, at least for federally insured credit unions, recording the exit exams will advance the exchange of information between the agency and credit unions and ultimately improve clarity in regulations and guidance. Thank you, Mr. Chairman. That concludes my remarks.
Thank you so much. Board Member Hood, you are now recognized.
Thank you, Mr. Chairman. And I also want to thank you, Melissa and Lindsay, for today's presentation, and also Eugene Sheed in the Office of OCFO for all the hard work that you all put forth in getting today's strategic plan before us. As I've said previously, the strategic plan is an important document about where the agency may be heading. And while the board does in fact approve this plan, I must say that it's my view that the chairman should be given more leeway to set the vision for how and where he would like to take the agency. The strategic plan is an aspirational document, and while I certainly believe that climate change is an issue, I simply do not believe it's an issue for the NCUA as the safety and soundness financial regulator at this time. Currently, my view is that credit unions know best how to manage and mitigate the risk in their respective communities, and not the NCUA. However, in the spirit of bipartisanship, I deferred to the chairman on the climate change language in the strategic plan, and I did so knowing that, again, this strategic plan, as an aspirational document, does not change any NCUA policy or supervision for climate change. We did get many comments on this issue, including one from the governor of North Dakota, Doug Burgum. Governor Burgum said that climate financial related risk, and I quote, is ill-conceived, politically motivated, anti-agricultural rhetoric that threatens to cause serious harm to the farmers and ranchers who form the backbone of rural America. If the climate decision, and I end the quote, if the climate decision was just up to me, I would not have climate-related financial risks in the strategic plan, but it was not my decision alone. I also know that this was indeed a top priority of Chairman Harper. And again, in the spirit of bipartisanship, I appreciate the language in the strategic plan before us that says, and I quote, the agency does not intend to micromanage credit union lending decisions for climate financial risk, including lending to family farms and others in the agricultural sector, as well as businesses tied to the fossil fuel industry. The NCUA board underscores that nothing in the strategic plan should be construed as discouraging activities related to agriculture or fossil fuels, end quote. And I know you heard that from the vice chairman as well, but I just wanted to add special emphasis. Furthermore, I've consulted with the Office of the General Counsel, and as a legal matter, the board adoption of the strategic plan does not change or alter NCUA policy and should not be interpreted by anyone to implement a future policy change. Changing policy will require a future board action. However, nothing that I've said today should constrain me or, quite frankly, lock me into a position, one way or another, for future action regarding climate change. I'm indeed open to studying this issue more and would like to see the best public policy option prevail. Now, I do have a few questions. Could someone please discuss the Access Initiative in the strategic plan and any lessons learned from the recent GAO report?
Sure, thanks for the question. In this 2022 to 2026 strategic plan, the Access Initiative is a core tenet of Strategic Goal 2. The goals and pillars of the Access program are reflected in the strategic objectives, strategies, and example performance goals. The annual performance plan, which will come before you later today, is guided by this strategic plan and proposes several performance indicators that tie directly to the Access program. These access-related performance indicators, which include metrics for chartering new credit unions, maintaining the level of members in MDI-designated credit unions, and distributing grants from the Community Development Revolving Loan Fund, may also contribute to addressing the lessons learned in the GAO report. The Access Initiative is also highlighted in the agency program section of the plan, which is new from the previous 2018 to 2022 plan. That concludes my response.
Great, thank you, Melissa. I want to shift gears a bit. Could you please highlight the significant changes to the strategic plan that were pretty much not in the last strategic plan that was approved? I know you referenced that, so.
Sure, thank you for the question. The 2022 to 2026 strategic plan is reorganized a bit to reflect our priorities over the next 5 years. Goal 1 was refreshed to include a new strategic objective related to addressing the opportunities and risks related to emerging financial technology. Consumer protection, which was previously in Goal 2, is also now a part of the objectives within Goal 1. Strategic Goal 2 now focuses largely on the agency's Access Initiative and other related priorities. Lastly, the agency's balanced regulatory approach now supports the priorities outlined in both Goal 1 and Goal 2. That concludes my response.
Great, thank you. And I'm glad that you referenced consumer financial protection as in the strategic plan. And I want to, though, talk about maybe overdrafts. And while overdrafts are not mentioned specifically in the strategic plan, I want to speak about overdraft fees since this has been getting a lot of press attention and also in almost all of my speaking engagements, it comes up during the Q&A. Can you confirm that the overdraft data collection highlighted in the 2022 NCUA Supervisory Priorities Letter is only a data collection effort at this point in time?
I'll take that question, Board Member Hood. This is Eugene Sheed. My understanding in talking with the Office of Consumer Financial Protection is as follows. That for context, in 2002 rather, the NCUA implemented a risk-focused examination program that you're familiar with. And under the exam program, examiners can adjust each exam scope based on those areas that represent a higher risk profile based on 7 categories of risk, such as transaction, strategic, reputational, etc., just to name a few. There are a few situations where examiners may, quote unquote, criticize, so to speak, a credit union's overdraft program. For example, if a credit union has a higher risk profile regarding overdraft practices, maybe a credit union has had issues in the past with overdrafts or overdraft-related consumer complaints, or maybe has litigation risk with pending class action lawsuits regarding their overdraft practices, then an examiner has the discretion to enhance their exam scope to do a more in-depth review. And this could happen during any exam cycle, regardless of the overdraft document request that we've specifically asked for this year. But additionally, for exams conducted in 2022, we only instructed examiners to obtain overdraft policies and procedures from credit unions. NCUA did not instruct them to review overdraft policies and procedures during the 2022 as part of the minimum scope requirements. However, an examiner may elect to review those materials as part of the risk-focused exam. Any violations noted by an examiner, such as a credit union lacking any formal written overdraft policies and procedures, may appropriately lead to some level of criticism and corrective action. The goal in obtaining the overdraft policies and procedures in disclosure documents this year is to have OCFP perform a more holistic review of overdraft protection programs to identify any heightened risk in developing necessary educational and outreach to the industry. If warranted, the NCUA may also develop exam procedures to target areas of heightened risk in subsequent years. The NCUA board approval would be required for any recommended regulatory changes and any recommended changes to board-approved examinations and supervision policies. That concludes my response.
Great, thank you, Eugene. Can you confirm that overdraft programs at credit unions are not subject to examiner criticism in terms of the overdraft data collection effort?
So again, as it specifically relates to the collection effort, that in and of itself is not supposed to be subject to examiner criticism. But as I noted, as a part of the exam risk program, overdraft could be considered depending on the particular circumstances.
I know, I wanted to just hear it reiterated because again, this is something that comes up almost at every public appearance. Can you confirm that any changes made to NCUA's oversight of overdraft fees will require future board approval?
Yes, so again, as noted, the NCUA board approval would be required for any recommended regulatory changes and any recommended changes to board approved examination and supervision policies. Yes, sir.
Great, and then finally, last year, as I recall, a report was due to the board as approved in a board action memorandum on consumer financial protection. That report has not been submitted under the timetable directed by the board. While the board has been updated on the status of this report, can you please let us know what the record is of the final status of it?
I believe it's still, I believe the board was notified last year by OCFP that would be delivered in 2022. It's under.
So it's in progress?
Yes.
Okay, very well. Thank you. I have no further questions or comments, and all of you, thank you for your hard work.
And thank you, Board Member Hood, for your detailed questions on overdraft fees. I get those questions as well when I meet with credit unions. And the fact is, we've seen a lot of headlines of credit unions and banks both making decisions to decrease or even drop their overdraft fees. You know, as I've talked to credit unions, I've said that credit unions need to be ready to respond to these changes, because certainly if they lose a source of revenue, if, as Vice Chairman Hauptman has pointed out, people walk with their feet and choose their best institution, there may be safety and soundness issues, and we've got to be aware of that and prepared on that. With that, let's turn to the final consideration of this item. Vice Chairman Hauptman, is there a motion?
Yes, sir. I move that the board approve NCUA's 2022 to 2026 strategic plan, which includes the agency's enterprise-wide risk appetite statement as attached to the board action memorandum.
Is there a second to the motion?
Second.
There is a sufficient second. All those in favor say aye. Aye.
Aye.
All those opposed say nay. The ayes have it, and let the record show the motion passes 3-0. That concludes our discussion of the strategic plan. As noted at the start of today's proceedings, we will now pause for a short break. Please bear with us as we bring in the presenters for our next panel. Thank you, everyone, for your patience. The second item on our agenda today is the NCUA's 2022 Annual Performance Plan. Staff presenting: Jim Holm, Supervisory Budget Analyst, Office of the Chief Financial Officer, and Nicole Whaley, Acting Management Analyst, Office of the Chief Financial Officer. Nicole, I understand this is your first board presentation. May you break a leg. And staff available for questions is Eugene Sheed, the Chief Financial Officer. Jim and Nicole, you may start at any time.
Thank you, and good morning, Chairman Harper, Vice Chairman Hoffman, and Board Member Hood. Nicole Whaley and I are here to discuss the 2022 Annual Performance Plan and request the Board's approval of the plan today. The Annual Performance Plan is important to the NCUA because it demonstrates to the agency's employees and our stakeholders the specific work the NCUA will do over the next year to fulfill its mission and make progress toward achieving its goals. In conjunction with the agency's multi-year strategic plan and its annual budget, we hold ourselves accountable for delivering results to the credit union member owners and to the general public. The strategic plan, which you just approved, is the foundational document that charts the course for the agency's actions and goals over the next 5 years. The annual performance plan is guided by the agency's strategic plan and provides greater specificity for the performance metrics and milestones the NCUA will monitor throughout this year to track our efforts to achieve the vision and goals of the strategic plan. The performance plan is updated annually in order to demonstrate our progress reaching the NCUA's strategic goals and to establish targets for the agency to achieve in coming years. In our agency's continued effort to integrate planning with budgeting, we worked with offices throughout the NCUA to develop initial performance metrics concurrently with the 2022-2023 budget, which you'll remember you reviewed and approved last December. In the draft budget submissions we received from the offices, they justified how their funding and staffing requests for new programs and for ongoing projects would help the NCUA achieve its strategic goals and objectives. As part of that budget process, we also asked offices to identify the specific performance indicators that demonstrate the results of the budget's investments. This annual performance plan before you now, in combination with the budget, shows how the NCUA will execute on our strategic plan this year. I would now like to turn to Nicole, who helped develop the annual performance plan while on detail to ACFO from the Southern region. We could not have developed the plan before you without her contributions. Nicole will discuss the specific contents of the 22 annual performance plan now.
Thank you, Jim. Good morning, Chairman Harper, Vice Chairman Hoffman, and Board Member Hood. As Jim mentioned, the annual performance plan is built on the foundation provided by the strategic plan and provides more detailed information about agency programs such as measurable targets and milestones for each goal established in the strategic plan. The annual performance plan also states the actions and activities the NCUA will perform to accomplish its strategic goals and explains how the agency will monitor progress in relevant areas of its operations. Important indicators in the 2022 annual performance plan include those related to the effectiveness of the NCUA's examination and supervision responsibilities, such as through monitoring the timeliness of examinations and the percent of credit unions with high CAMEL ratings, demonstrating the results of budget investments in consumer compliance activities, addressing barriers to the adoption of new financial technology, and obtaining and analyzing feedback from credit unions on agency processes. The agency's efforts to improve access to affordable and equitable financial products and services through improvements to the agency's chartering and field of membership processes and minority deposit institution initiatives, and the quality of the agency's operational support to NCUA employees and the public through our efforts to deliver best-in-class information technology products, human capital management, and financial management services. The CFO's office is responsible for measuring and reporting on progress implementing the actions that NCUA offices take to meet the agency's performance goals. Although today's agenda item is for approval of the 2022 annual performance plan, I would like to remind everyone that NCUA also publishes a retrospective annual report. The annual report for 2021 was published yesterday and includes a line-by-line update showing the NCUA's progress in each of the performance measures set for last year and discusses the reasons for any variance or change in performance trends over the past 12 months. The current and recent annual performance plans and annual reports, as well as the NCUA strategic plan, budgets, and financial statements can all be found on the ncua.gov website. Thank you for your time today. This concludes our presentation. We are happy to answer your questions.
Thank you so much, Nicole and Jim, and congratulations, Nicole. You did a great job. Also, thank you, Eugene, and to Melissa Loudon and the rest of the team in the Office of the Chief Financial Officer for your exceptional efforts in preparing the performance plan for the board's consideration today. Like many on the NCUA team, the All-Star team in OCFO has been working nonstop. In coordinating the development of this performance plan, you all have maximized organizational performance to enable mission success, which is one of the agency's 3 strategic goals. Please know that I greatly appreciate your dedication, guidance, and service. Thank you. I also want to thank my fellow board members, Vice Chairman Hauptman and Board Member Hood, for suggesting the inclusion of performance metrics related to financial technology, share insurance fund transparency, regulatory efficiency, and financial inclusion. We incorporated these and other suggestions into the final document. Your ideas and insights definitely made this plan much, much better. In short, the 2022 annual performance plan reflects a consensus of the priorities of all of the NCUA board members and the recommendations of staff. It sets out performance measures and aligns them with the agency's strategic plan, which the board just approved. Each day, the NCUA strives to ensure a safe and sound system where credit union members are protected, access to fair and affordable services is improved, and confidence in the national system of cooperative credit is promoted. The many metrics in this plan keep us focused on achieving these goals. This year, the NCUA board's main priority is to ensure that the credit union system and the Share Insurance Fund can adapt to the evolving financial and economic disruptions brought on by the COVID pandemic. With the geopolitical crisis unfolding in Ukraine, the NCUA will also continue to prioritize cybersecurity and guide the credit union system through the economic uncertainty caused by inflation, rising gas bills, and continued supply chain woes. Additionally, in 2022, the NCUA will continue its efforts to evolve its examination program and operations, expand access to safe and affordable financial services, and provide consumers with financial education and close the wealth gap. In sum, the annual performance plan is a robust work product. It contains important metrics to ensure the credit union system remains safe, sound, and secure. It strengthens consumer financial protection and fair lending programs, and it addresses emerging issues like financial innovation, cybersecurity, and climate-related financial risk. I look forward to working alongside my fellow board members and the entire NCUA team to achieve the objectives set out in this plan throughout the year. That concludes my remarks. I now recognize Vice Chairman Hauptman.
Thank you, sir. And thank you, Jim, Nicole, and everybody who worked on the annual performance plan. This document is intended to set our annual priorities within the overarching goals of the strategic plan. In brief, they are 1, ensure a safe, sound, and viable system; 2, improve the financial well-being of individuals and communities; and 3, maximize NCUA's organizational performance. I'm pleased to see more emphasis in the plan on quantifiable indicators. What gets measured is what gets done. This is an improvement over last year's plan. I know we can include more of such measures in the future. In addition to safety and soundness, my guiding principles are regulatory clarity and open, transparent communication with stakeholders. Ensuring safety and soundness, advancing the well-being of members, and maximizing the agency's performance can only improve with a commitment to clarity and open communication. I appreciate my fellow board members' support for improving regulatory clarity by addressing rules that may conflict with each other, such as those around participation loans. and the support from the board and staff for clarity around credit union fintech innovation. Open and transparent communication assumes NCUA isn't just talking at credit unions. For us to truly ensure the quality and consistency of examinations and examination reports, we need credit unions' help in normalizing quality assurance tools such as feedback surveys and the use of recordings during exit meetings and joint conferences. Recording exit meetings and joint conferences has been part of the supervisory manual for years for federally chartered credit unions. But then with the pandemic and the use of Zoom and Teams for meetings with credit unions, recording has become much easier and more expected. These recordings are beneficial for the agency and the credit unions as they provide an invaluable resource for new examiners, credit union staff, and boards, as well as ending any questions of what exactly was said. To open the lines of communication with credit union organizing groups, we're making the new chartering guide a living document. I want to thank the CURE staff for committing to seek ongoing input from users of the guide and updating it regularly. Regarding our credit union diversity self-assessment, I don't exactly agree with the wording in the annual performance plan, but I don't dispute the importance of diversity in the credit union movement. In fact, the credit union movement itself is astonishingly diverse. Credit unions were the original answer for financial inclusion and underserved groups, such as faith-based populations and ethnic groups. They found a home in the credit union movement. But those very diverse fields of membership can sometimes put a constraint on the diversity of individual credit unions. I have reason to believe that one reason credit unions haven't returned our survey is due to the very nature of some fields of membership. For example, we've been talking lately about the 12 ethnic Ukrainian American credit unions. Other credit unions may have boards entirely composed of members of a particular place of worship or members of one Native American tribe. And that is their business, not NCUA's. We haven't made that as clear as we can. And when this agency wants to make something clear, it does so. For example, a few years ago, NCUA adopted, right or wrong, a no tolerance policy on employee use of cannabis. We can adopt a similar stance for this diversity survey and make it clear that no NCUA employee has any business commenting negatively on a credit union's demographics. Another thing we hear from credit unions is they want assurances that their individual information won't be used against them or against the credit union movement. We can and should address this directly, for example, by anonymizing the surveys. If we do these things, I know we'll see greater utilization of this tool. Mr. Chairman, that concludes my remarks.
Thank you so much, Mr. Vice Chairman. And I really like your line, what gets measured is what gets done. I often say that if you don't measure it, you can't manage it. And we have a similar philosophy in that way. And I also agree with you that we need to be looking at the barriers that are happening with respect to the diversity, equity, and inclusion self-assessment. It's an important thing. Board Member Hood, you may now have any remarks that you may want to give.
Great, thank you, Mr. Chairman. But let me first begin by thanking Jim and Nicole for their presentations this morning. And Nicole, we're so delighted that you've made your debut with us today, and what a great presentation. Regulation is vitally important in ensuring the safety and soundness of the credit union system. Many of you have heard my regulatory philosophy, and it's this: regulation should be effective and not excessive. That is why I want to see a regulatory system that is effective and not excessive, as we fulfill our primary mission of protecting the safety and soundness of the credit union system and the Share Insurance Fund. As we look back, though, to last year's APP, I know we were talking earlier about one of the business tenets of what gets measured and what gets done. Could someone maybe tell me how many targets were met and how many were not met?
Yes, sir. Thank you for that question. This is Jim Holm. When we look at the results for 2021, which, as Nicole mentioned, were just published yesterday to the public, we tracked 49 performance indicators. The agency met or exceeded its target for 34 of those indicators. We missed our target for 14 of the indicators. And for one indicator, the data was not collected by a third party, so the results for that indicator are not available. That concludes my response to your question.
Great, thank you, Jim. I'd just like to note that I really do support having stretch goals, but I do have to ask, what are some of the actual steps to hold staff accountable for the implementation of the 2022 plan?
Yes, sir. Thank you for that question. I'll give you an answer. It's a good question, given the agency's commitment to transparency and accountability. And we have several mechanisms the NCUA uses to establish accountability for accomplishing performance targets. So first, I'd point you to the 46 specific measures in the 2022 plan that is before the board right now. We have 46 measures and milestones in that plan. Within the set of indicators are a blend of agency-wide items and items more focused on a particular office's performance. Each performance indicator is assigned to a lead office within the NCUA, and so that establishes the accountability for reporting on the specific measures. As we proceed through the year, the lead offices report their performance at least quarterly, and they assess that performance against those particular measures and milestones. The CFO's office collects these quarterly results and compiles the data into a report that is sent to NCUA leadership. If we find during the year that resource issues are preventing an office from reaching its performance targets, we can address those challenges as part of the NCUA's mid-session budget review or through a budget reprogramming at other times of the year. Those processes allow us to adjust resources as necessary to keep programs on track to meet their targets. The agency also builds accountability into its executive performance management system. One element included in all executives' annual performance ratings is results driven, which factors in performance toward the agency's performance goals and the indicators established in the plan. In the performance rating context, not meeting a performance target is balanced with the review of the underlying factors that contributed to why the goal was not achieved. And then finally, the last way we ensure accountability is by releasing the annual results in our annual report, as Nicole discussed, and as I talked about in response to your first question, sir. That report is publicly available. It ensures transparency about the agency's performance, and it discusses why the agency did not meet some of its targets for the year. And for those targets that we didn't meet, it explains how the agency intends to strengthen its performance going forward. That concludes my response to your question, Mr. Hood.
Great. Thank you, Jim, for a very robust response. The 2022 annual performance plan before us today is about looking ahead, and I am indeed pleased to see that we're adding a metric on making the normal operating level calculation public, in addition to having metrics established for fintech regulation and distributed ledger technology. I'm also glad and pleased that we will be looking at low-income designations and the impact the recent census survey may have on these areas. I fully support the idea that credit unions that are once a low-income designated credit union should always be a low-income designated credit union, because we should want areas to grow out of this designation. Additionally, this is how the NCUA treats underserved areas today. In other words, once an underserved area, always an underserved area. I have no further questions or comments, and thank you, Mr. Chairman. I yield back my time.
Thank you so much, Board Member Hood. Is there a motion?
Yes, Mr. Chairman, I move that the board approve NCUA's 2022 annual performance plan as attached to the board action memorandum.
Is there a second to the motion?
I second the motion.
There is a sufficient second. All those in favor say aye.
Aye.
All those opposed say nay. Let the record show that the ayes have it and the motion passed 3-0. That concludes our discussion of the annual performance plan. As noted at the start of today's proceedings, we will now pause for a short break.
Nice job.
The third and final item on our agenda today is a board update on the corporate system resolution. Staff presenting, Keith Morton, Southern Regional Director and AMAC President, Brian Heitman, Senior Capital Markets Specialist, Office of Examination and Insurance. Staff available for questions include Eugene Sheed, Chief Financial Officer, and Jeff Zick, Associate General Counsel, Office of the General Counsel. Brian and Keith, you are now recognized.
Thank you very much. Good morning, Chairman Harper, Vice Chairman Hauptman, and Board Member Hood. Brian and I are here today to provide you an update on the Corporate System Resolution Program, including information on the recent distribution to capital note holders and the former members of the failed corporates. In addition, Associate General Counsel Jeff Zick and Chief Financial Officer Eugene Sheed are joining us to assist in answering questions. We'll post this slide presentation as well as our prepared remarks on the NCUA website. Unless noted otherwise, the information in today's presentation is based on December 31, 2021 data. The asset management estate data used for determining the distribution uses NCUA's audited year-end financials. It is also important to note that some of the information and projections we're providing today represent point-in-time estimates as of the dates noted on the slides. Much of the information is generated using projected cash flows for the legacy assets, that is, the securities from the failed corporate credit unions, and therefore is subject to change. The future cash flows of the legacy assets are projected by BlackRock based on proprietary models that consider key macroeconomic factors such as housing prices, market rates, and unemployment level, as well as a wide variety of current characteristics and historical performance variables at the asset level. I will now turn it over to Brian Heitman to provide some background information. Brian, the floor is yours.
Thank you, Keith. Good morning, everyone. This is Brian Heitman. During the economic crisis, several corporate credit unions, most notably U.S. Central, Westcor, Members United, Southwest, and Constitution Corporate, had come under severe liquidity and capital pressure in 2008 due to high concentrations of primarily non-agency residential mortgage-backed securities. As of 2009, the total unpaid principal balance for the distressed securities was $52.7 billion, but their market value was less than $22 billion. Thus, market losses from these five corporates would have exceeded $30 billion, an amount far in excess of the Share Insurance Fund's then $11 billion balance available to cover those losses. We estimated the probable failure of thousands of consumer credit unions with uninsured deposits in these institutions, which would have resulted in a cost to the credit union system estimated at $40 billion. The agency's corporate system resolution program prevented that scenario. Stakeholders will recall that the corporate system resolution program had three goals: to stabilize, resolve, and reform the corporate system. The extraordinary liquidity support programs put in place during the stabilization phase of the program have all since expired, and in the case of the stabilization fund, closed early. Another key element of the resolution phase, the NCUA Guaranteed Note or NGN program, ended last year. The following steps remain. The NCUA will continue to orderly liquidate the legacy asset securities that have been collateralizing the NGNs. The NCUA will continue to pursue litigation related to the remaining legacy assets. The NCUA will continue to make distributions to corporate capital holders every 6 months in March and September, subject to available cash. Next slide, please. Slide 3 provides some high-level statistics on the current and original status of the NGNs and the associated failed corporates' legacy assets. We use December 2011 as the reference point, as it is the first year end for which all the NGNs had been issued, meaning that it provides a comparable basis for totaling outstanding balances, market values, and losses. Adding up the nominal amounts at the time each NGN was issued, we actually securitized over $40 billion of legacy asset face value, with total proceeds raised through the NGN securitization of $28.3 billion. As of December 31, 2011, the total legacy asset unpaid principal balance across all NGNs was $34.3 billion. You can see in the realized legacy asset losses line that $9.7 billion of realized losses have occurred to date, with total remaining losses estimated to remain stable, meaning the vast majority of expected losses have already been realized. Further, due to the success of the corporate system resolution program, projected lifetime legacy asset losses have declined between $3.5 and $6.7 billion since the original estimate in 2011. NCUA uses cash flows projected by BlackRock to estimate the net realizable value of the legacy assets associated with the NGN program. As of December 31, 2021, the market value and net realizable value of the remaining legacy assets is $900 million on an unpaid principal balance of $2 billion. As noted previously, there is no longer any balance owed to NGN investors. Next slide, please. This table shows the total corporate system resolution costs, as well as how that cost is broken out between federally insured credit unions and depleted corporate capital holders. As of the fourth quarter of 2021, the projected lifetime legacy asset losses are $9.7 billion, as shown here and on the previous slide. Due to guarantee fees earned by insuring the NGNs and beneficial excess interest from the underlying legacy assets, we expect $1 billion to offset the lifetime losses. After accounting for direct legal recoveries received of $3.8 billion, the total net costs are projected to be $4.9 billion. Thus, in addition to preventing losses and stabilizing the credit union system, the corporate system resolution, which included the NGN program, provided beneficial excess interest and guarantee fees and preserved the rights to over $3.8 billion in net legal recoveries. Next slide, please. The NCUA has received net legal recoveries of $3.8 billion over the course of the corporate system resolution program. As I mentioned previously, these recoveries would not have been possible if the NCUA had liquidated all legacy assets immediately rather than resecuritizing them and creating the NGN program. The recoveries were instrumental in allowing the asset management estates to be in a position to make distributions to membership capital account and paid-in capital holders. Next slide, please. Next, we'll discuss the three remaining components of the corporate system resolution: liquidation of legacy assets, remaining litigation, and corporate asset management estate distributions. Next slide, please. The first component we'll discuss is the continuing liquidation of the remaining legacy assets that are available for sale, that is, those that are not subject to legal holds. The liquidation has three primary objectives: perform an orderly, timely liquidation while also ensuring best execution under existing market conditions, sell available for sale assets through bid, wanted, and competition auctions and other processes as needed, allow assets with short expected remaining lifetimes to pay down naturally. Next slide, please. Slide 8 summarizes the legacy asset sales through year-end 2021 by asset management estate. As you can see, the NCUA has sold over 1,000 legacy assets with a face value of approximately $6.2 billion, resulting in proceeds of $5.3 billion. Sales to date have netted $300 million above NCUA's book value for these assets. Next slide, please. Slide 9 shows the count, face value, and market value of the remaining legacy assets by asset management estate. As the table shows, there were just under 200 assets remaining with an estimated market value of $900 million as of the beginning of March. The bonds available for sale were just over $560 million. The NCUA has plans to liquidate these assets in an orderly fashion, assuming market conditions remain favorable for sales. In fact, we sold 35 of these assets yesterday with proceeds of $205 million. I'll now turn it over to Keith to talk about the asset management estates and the projected distributions to capital holders.
Thank you, Brian. Brian just described the corporate system resolution program's original goals and the remaining resolution components. As you can see, the NGN securitization program, which expired in 2021, played a critical role in effectively mitigating losses to the National Credit Union Share Insurance Fund and ultimately the credit union system. And as we enter the final stages, we remain diligent in aggressively pursuing legal recoveries and orderly liquidating and monetizing the remaining legacy assets as they become available for sale and no longer subject to legal holds. On the legal front, our current caseload includes 2 trust deed, 10 LIBOR, and 2 repurchase lawsuits, all of which are in varying stages of advancement. At the outset of the corporate system resolution program, projections indicated that members of the failed corporates would not likely receive any recoveries for depleted capital. However, the program has been very successful to date and positioned the liquidating agent to make distribution to the industry of nearly $2 billion with total claims satisfied of $2.2 billion. In addition to the satisfaction of claims, the shareholders of Southwest Corporate received a $210 million liquidating dividend, which is the equivalent of 2.3% of shares. This dividend was paid earlier this month as the Southwest Corporate Asset Management estate was in a surplus position. The Asset Management Assistant Center is charged with the administration of the asset management estates. As liquidating agent for each failed corporate, the NCUA manages independent books and records for each estate. A separate accounting for the estate's assets, liabilities, recoveries, and expenses is maintained to ensure we protect the interests of the respective creditors, claimants, and members. This slide depicts how NCUA's Rules and Regulations, Part 709, governs AMAC's administration of the asset management estates. Going from left to right, A1 to B9, we show the priority of payment as defined by the regulation. In paying out insured shares, expenses of the liquidation, and NGN program costs, the share insurance fund became the claimants under B1, B4, B6, and B6.5. With respect to U.S. Central, Members United, Southwest, and Constitution Corporate, all claims have been paid or provisioned for up through the B6.5 level. Westport is not projected to be able to repay the share insurance fund's claims of $2.6 billion, as shown on this slide as B1, B4, and B6 claims. Thus, we do not project any recoveries to Westport's former capital holders. The ANE payout priorities per NCUA rules and regulations require all senior claims up to and including the B6.5 level must be paid or provisioned for prior to making a distribution to the membership capital and paid in capital claimants, which fall into the B7 and B9 categories. Further, if a surplus remains after making distribution in full or on all allowed claims through B9, such surplus will be distributed to the Creighton shareholders pro rata as a liquidating dividend, as I just described occurred to the Southwest shareholders. Slide 11, please. The liquidating agent will continue reviewing the financial information of each corporate AME following the June and December quarterly reporting periods to determine if cash is available for a distribution. If sufficient funds exist to make a distribution, distributions will be made in March and September of that year. Advance notices of any potential distribution will be sent out via email to the affected credit unions using the email address on record with the NCUA. During the first quarter of 2022, the program met several corporate distribution milestones. Constitution Corporate member capital account claim holders received their first distribution. Members United member capital account claim holders were fully repaid, and Southwest shareholders received their first pro rata liquidating dividend as the estate had a surplus of $210 million. As previously stated, Westport capital holders will not receive a distribution as the share insurance fund has a senior claim of $2.6 billion. Slide 12, please. This slide reflects the original member capital and paid-in capital claims for the estates able to make distributions in their capital claims paid to date. First, I will start with U.S. Central. U.S. Central's combined member capital and paid-in capital claims was nearly $2 billion, and after nearly $1.3 billion in paid capital claims, the U.S. Central Asset Management estate has returned 65% of capital claims, leaving $700 million of remaining claims. Current projections indicate an additional $522 million in capital distributions over the life of the estate, which would result in a nearly 90% return of original capital claims. Next, Members United held combined member capital and paid-in capital of $572 million at liquidation and have returned $493 million in paid-in capital claims to date. This represents 86% of their aggregate capital claims. The Members United Asset Management estate fully repaid its member capital claims during the March 2022 distribution, and projections indicate the estate will ultimately pay out their $79 million in outstanding paid-in capital claims. In addition, we project a pro rata liquidating dividend of $45 million will also be paid to shareholders at some point in the future, but not likely before 2023. Southwest's member capital balance at liquidation was $404 million, and these claims have been 100% repaid, culminating with the estate's September 2021 interim capital distribution. I would note that during the March 2022 distribution, the Southwest Asset Management estate made a liquidating dividend of $210 million, or 2.3% of outstanding shares. The estate projects another $122 million in liquidating dividends to be paid out in the future as funding permits. Constitution held a member capital balance of $67 million at liquidation and provided its first member capital claim holder distribution of $16 million during March 2022, representing 24% of their original member capital. Projections indicate an additional $29 million will be repaid in the future, which would represent a return of 67% of original capital claims. Of course, the timing and amount of future distributions will depend on future performance, the availability of cash through the orderly liquidation of assets, payment of senior claims, and the resolution of the current outstanding lawsuits. Any projections disclosed are point-in-time estimates and subject to change. Slide 13, please. In March 2022, the NCUA, in its role as liquidating agent, delivered interim distributions of $547 million to over 2,100 active credit unions and 11 corporate credit unions after provisioning for known liabilities. Distributions from the U.S. Central Asset Management estate to other estates accounted for $130.2 million of the distribution. Non-credit unions and voluntary liquidations account for $6.7 million of the distribution. Members United, Southwest, and Constitution received distributions from U.S. Central for their claims they had against U.S. Central. These distributions totaled $114.9 million in March, providing a recovery of $57.8 million to the Members United estate, $50.7 million to the Southwest corporate estate, and $6.5 million to the Constitution corporate estate. These three states are both claimants of U.S. Central and payers of claims to their own respective claimants. Thus, these pass-through payments of $114.9 million have been netted on the table to reflect the amount of cash payments made to the industry. Overall, an aggregate $683.9 million in claims were satisfied and dividends paid during the March 2022 interim distribution, which resulted in $569 million in funds to the industry. With this fourth round of distribution, the NCUA has returned to the industry almost $2 billion for the former capital holders and nearly $210 million in liquidating dividends to shareholders. Next slide, please. This concludes our presentation. We would be happy to answer any questions you have.
Thank you, Keith, and thank you, Brian, for your presentation. And a special thank you to everyone on the NCUA team, both past and present, for your steady stewardship of the asset management estates of the 5 failed corporate credit unions and the NCUA Guaranteed Notes Initiative. We could not have gotten to this point without your collective efforts, leadership, and wisdom. Thank you again, everyone, for your truly extraordinary efforts over the last decade. It has taken us a long time to get here, but we are at long last entering the final phase of the corporate system resolution. By pursuing the least costly resolution, the corporate crisis and taking bold action in court, we have recovered and returned, as Keith pointed out, nearly $2.2 billion to member capital account holders, with the potential for more distributions in the months ahead. Nevertheless, some continue to question our actions. Skeptics of the corporate system resolution claim the NCUA overestimated the losses. Others assert that the corporates were merely experiencing a liquidity crisis, but were otherwise financially sound. Such sentiments sincerely and seriously minimize the true nature of the crisis the agency faced between 2008 and 2010. Let me state this clearly. The 5 corporate credit unions that failed were insolvent. That is a fact. Like a gambler busted at a blackjack table, they ran out of money. The game was over. Promising the dealer you will have cash once you win the next few hands does not work in a casino, and it certainly does not work for financial institutions. What came next was the need to resolve these failed institutions in a responsible manner and in a way that did not endanger the entire credit union system, which was under enormous stress during the 2008 financial crisis and the resulting recession. That is why we structured the corporate system resolution to allow the credit union system to bear the cost of failures over time. Those costs, based on the best available information during that chaotic period, were initially estimated to be between $13.2 billion and $16.4 billion. That exceeded the total assets that were in the Share Insurance Fund at the time. While our cost estimate is $9.7 billion, the current cost estimate that is, that estimate is and includes the gross recoveries from our legal actions against the firms that sold those faulty securities. Without those proceeds, the estimated cost of the system's corporate failure would have been much, much higher. And had the NCUA not taken the prudent steps that it did during the corporate crisis and over the last decade, including pursuing legal action, the credit union system would have had to endure those enormous losses, costs the system simply could not absorb. We must also acknowledge another factor to the NCUA's success: luck. Nothing over the last decade was guaranteed. Nothing. When we first developed the NCUA guaranteed notes, we had no guarantee that investors would purchase these assets. We also had no guarantee that the real estate market would recover and home values would return to and later surpass pre-financial crisis levels. We also had no guarantee of a strong economic recovery following the Great Recession. What is more, we had no guarantee that a law firm would pursue legal cases against the financial firms that sold those securities, or that the firm would do so on a contingency fee basis, which made taking such legal action remotely possible. And we had no guarantee that these lawsuits would be successful, let alone result in more than $5 billion in gross recoveries to date. Good fortune, it seems, favors our nation's credit union system. Why? It's because all of those outcomes occurred despite the considerable odds. This luck, combined with the incredible talent of the NCUA's team, the steadfast leadership of previous NCUA chairmen and board members, and the excellent work of our outside legal counsel, is the reason we can report such good news today. Let's recognize the corporate system resolution for what it really was. It was an innovative solution that saved the credit union system far more than it cost. While we may never know what the system would have looked like if we had not acted boldly, I know for certain that it would have not remained a dynamic, innovative, and healthy and resilient cooperative system that we see today. And we would have had considerably fewer credit unions. As we enter this final phase of the corporate system resolution, the NCUA will continue to hold accountable those bad actors who contributed to the corporate crisis, minimize costs, and maximize our recoveries and returns. And on that note, Brian, thank you for getting $210 million yesterday in asset sales. That does bring me to my first question. Brian, would you explain our approach to liquidating the remaining assets so that we can maximize potential returns?
Thank you for the question, Chairman Harper. This is Brian Heitman. We plan to continue with our current orderly liquidation approach. We monitor the market to ensure conditions are conducive to sales and price indications from broker-dealers compare favorably to our book values. Then we hold what's called a bid wanted in competition sale, where we typically receive bids from more than 20 broker-dealers and award bonds to the winning bidders. Broad participation ensures fair market value is received and returns to the industry are maximized. That concludes my response.
Thank you, Brian. Your answer underscores the NCUA's careful management of these assets and our recovery efforts. My second question focuses on the process of selling these assets. As we wind down these legacy assets, how do current economic conditions and financial market expectations potentially affect our approach to resolving any remaining assets?
This is Brian Heitman again. Current economic conditions and financial market expectations could potentially affect the timing of the liquidation. As I mentioned in my previous response, before conducting a legacy asset sale, we collect price indications from broker-dealers to ensure that market conditions are favorable. If price indications or other information we receive from market participants show that the market has weakened, whether due to current events or for any other reason, we may temporarily postpone sales of the remaining assets. We held a sale yesterday in which we sold 35 legacy assets to 12 different broker-dealers with proceeds totaling over $200 million. The market does appear to suggest a strong bid for these legacy assets, despite current events, and confirms the NGN support team's efforts in assessing market strength and in communicating with the broker-dealers. That concludes my response.
Brian, I very much appreciate your stewardship here. This next question is a legal question. It's probably for Jeff. I would like to focus briefly on the lawsuits pursued against bad actors. We were the first federal financial institutions regulator to bring lawsuits against the Wall Street securities firms that sold investments in faulty residential mortgage-backed securities. People told us we would never win, and some criticized us for using contingency fees. Yet, without these contingency fee legal actions, would the NCUA have been able to return any money to the credit unions that once owned the failed corporates?
Chairman Harper, this is Keith Morton.
You're going to take
I'll take the question.
Sure.
To date, the estates have received $3.8 billion in net legal recoveries after providing for the contingency fee. And these legal recoveries have contributed to the estate's ability to pay out nearly $2 billion in capital and another $210 million in bonus dividends. That concludes my remarks.
So if I'm hearing you correctly, we received net proceeds of 3.8 billion, and we've distributed 2.2, and without that 3.8 billion, there would have been no 2.2 billion to this point. Is that correct?
Yeah, that's correct. Of course, we also receive recoveries from the NGN program and the underlying securities, but specifically with respect to legal, yes, you're absolutely correct.
Great. Thank you. I have one last question. I know that we just announced a $560 million distribution, and you outlined some potential distributions in the future. Do we have a sense of when eligible credit unions might receive additional payouts?
Yes, sir. This is Keith Morton. The liquidating agent has established a practice of making distributions semi-annually in March and September based on the prior quarter and financials. In light of recent and projected sales of available for sale securities, I do anticipate the estates will be in a position to make another distribution in September 2021. That concludes my remarks.
Great. In closing, the NCUA will continue its fiduciary responsibilities in winding down the remaining asset management estates of the 5 failed corporate credit unions, and we will return additional funds to capital holders. I encourage all credit unions receiving this windfall to provide safe, fair, and affordable financial services products to the millions of credit union members experiencing economic difficulty, especially to communities of color and those in underserved, low-income, and rural areas. Given the cooperative philosophy at the heart of the credit union movement, credit unions have a moral obligation to step up and to help those individuals and communities recover and start anew in the months ahead. Again, thank you, Keith and Brian, for your excellent work. That concludes my remarks and questions and comments. Board, where is he? Vice Chairman Hoffman, the floor is yours.
Thank you. And thank you, Keith and Brian. This is certainly good news today. And as regulators, we're often in a position of playing the Grinch. And I have to say, being Santa is more fun, even if we're just giving people back their own money. The first time we had a briefing on this, I gave you a bit of a hard time about our communication process. And back in 2011, at the start of the program, the original assumption was don't expect much money back, if anything. Fortunately, as Chairman Harper just said, that changed. And we've had several significant distributions over the past 2 years. But not only did the assumptions change about the money, so did the credit unions. Mergers, new CEOs, staff turnover, it eroded the institutional memory of what had happened. So unless a credit union kept track of the original documentation, they weren't expecting to get a check, nor had much idea of when or a ballpark idea of how much they'd get. And even if they did have the documentation handy, we were expecting them to come to us, search our website, or perhaps rely on corporate credit unions to relay the information. And we are responsible for the credit union's money. I think we agreed last year that we could have been better at communicating with the credit unions. Credit unions were making budget decisions, and a CEO that didn't know they had this money coming to them made decisions about staffing and resources that might have been different if they had known. I'd hate to have been a credit union employee that was laid off because the credit union didn't realize there was extra cash coming to them due to this program. And as I said, it's welcome communication that we shouldn't be gun shy about making. Handing out cash makes it pretty popular. I want to congratulate you for the work you and your team have done to improve communication, including a concerted effort to push information out to the affected credit unions. Whenever we are managing their money, it's our responsibility to go to them with the info, not expect them to come to us. So one question I have is just relative to the earlier distributions, what are the changes you made to communicate with credit unions and the corporates?
Yes, this is Keith Morton. I'll take that question, Vice Chair. And thank you for the question, and thanks for challenging us to continue to improve our communication process. I appreciate it. Our biggest challenge, as we discussed last year, was estimating projected recoveries. That challenge still remains today. But what we do is work through it. We try to get a good sense that we'll be able to make a distribution. And when we are confident that we can, we'll communicate early and with a specific range of potential recovery. We draft and send emails to the CEOs advising them of projected recoveries, and we provide this communication as soon as possible. The original email includes an estimated amount of the distribution, projected distributions for subsequent periods, and ultimate projected recoveries over the life of the estate. Once the books have been closed on the quarter ending period, either December 31 or June 30, we calculate the actual distribution amount and notify the credit unions again by email and follow that up with letters communicating the distribution amount, which is subsequently made by ACH in either March or September. We also provide links to information we maintain on the NCUA website for ease of reference, as well as contact information where credit unions can call and discuss the process and ask questions. That concludes my response, sir.
Thank you for that. It sounds like good news, not just the money, but the communication process. I appreciate the changes you made and bearing with me when I talked to you last year about this. And I'll say, listen, in my prior life, I was a debt trader for 7 years. I understand there's uncertainty about what prices you're going to get and when you'll make sales. But I think a general notion is very useful. For example, in my family, in my head, I have an idea I'm going to get a tax refund later this year of a ballpark amount. And, if it was $1, I wouldn't even care about it. And I also know, I'm unfortunately not going to get 50 million back from the IRS, right? I have a general notion and it fits into my family's financial planning. So can you just review again about how many credit unions will receive a distribution in 2022 and ballpark average payment amounts for the year?
Yeah, so this is Keith again. 2,100 credit unions received a distribution in March, and 11 corporate credit unions also received a distribution. It's my sense that we'll also be able to make a distribution to the estates in September of this year based on June 30 information. It's a little hard to give you an exact estimate or an estimate to each individual credit union because it depended on their claim holdings.
Yeah, that's why I asked average,
Yeah.
amount of money divided by how many credit unions for this year, ballpark. We know it's not going to be in the trillions. We know they're not going to get 50 cents, just ballpark.
Yeah. Let's see. Would have been, I guess, around $2,500, I guess.
All right, sure. Nobody's going to hold you to that. We understand
Yeah.
that. But it's just like my tax refund. It's a ballpark.
It varies. Yeah.
It's a ballpark amount in my head. I know that, it's going to be a nice chunk of money when I get my refund, but I'm not going to buy a beach house with it. I can say that. And you said 2,100 got a distribution in March of this year, and we ACH that money. Is that correct?
That is correct.
And do you believe that all 2,100 prior to the receipt of the ACH were aware that money was about to hit?
Yes, we hope. We communicated to the credit unions. It's certainly the intent of our communications to advise them. We did receive some questions, into our help desk. I received some directly myself by email, and I contacted those creditors and walked them through. So yes, there's still questions that remain, and there's opportunities for continued improvement on the communications. But between the website, the emails, the letters, and press releases, we hope the message gets out there, at least to the masses. And based on the limited calls we received, I think it has.
Gotcha. We just don't want anyone to wake up one day and like, wow, look, my account's higher. We got, it's a good problem. But yeah, and I understand you got people pinged you directly. Somebody with a bunch of cash to hand out tends to get a lot of attention. So I understand that, and well done on the whole program. Thank you, Mr. Chairman. That concludes my remarks.
Thank you so much, Mr. Vice Chairman. Board Member Hood, you are now recognized.
Thank you, Mr. Chairman, and thank you, Keith and Brian, for today's very positive presentation. I think it's safe for me to say there's finally light at the end of the tunnel with the corporate system resolution. I'd like to thank the NGN Oversight Committee and its staff from the Asset Management Assistance Center and the Office of the Chief Financial Officer for all of their work in administering the affairs and finances of the asset management estates. The good news is that the agency has provided a distribution to the capital account holders and the possibility of future dividends. There is no question the industry has greatly benefited from this effort. Keith, as you know better than anyone, this has been going on now for about 12 years. When can we expect this to be fully resolved?
Yes, thank you, Board Member Hood. This is Keith. We are indeed nearing the end, and as we presented, we're in the final resolution phase. In short, we hope to wrap up the corporate resolution program, make distributions, and close out all active asset management estates in 2023, next year. This timeline, of course, is dependent on the market conditions, which enable our ability to continue to orderly liquidate securities and monetize assets, and the resolution of the remaining outstanding legal cases. This concludes my response.
Great, thank you, Keith. While I support a corporate system resolution as soon as possible, I also believe that we also must stay the course with any of the pending lawsuits before we can really bring this matter to a close based on our legal contract, which is also in our fiduciary interest. If we could please turn to slide 13, we see the payouts to the industry. In that regard, I do have a few questions. In specific, how much have we spent on contingent legal fees to date in the case?
Thank you, Board Member Hood. This is Jeff Zick. I can answer that question. The contingency fees paid from the legal recoveries to date is approximately $1.2 billion. That concludes my answer.
Great, thank you, Jeff. Do we have any restrictions in place that caps our spending on contingency legal fees and instances going forward?
Thank you, Board Member Hood. This is Jeff Zick again. I can answer that question. No, there are no restrictions in place going forward. Whether the board as liquidating agent or conservator wants to restrict the use of contingency legal fee agreements in the future is a policy decision the board can make on a case-by-case basis after analyzing some of the same factors it did so here, namely the complexity of the litigation, the novelty of the litigation, likelihood of success, the protracted nature of litigation, and the cost of the litigation to the former credit union members and to the share insurance fund. Placing a cap on the contingency fees paid in a contingency legal services agreement would be a matter to be negotiated between the parties to that agreement. So if a party wanted a cap on contingency fees, it would negotiate that provision with the other party to the agreement, and both parties would have to agree to such a cap. That concludes my answer.
Well, great. Thank you, Jeff. I just note that I really do support updating our policies to have caps on contingent legal fees in the future. So I certainly would like to work with this board to act in regard to this change in our policy. One final question regarding the legal contingencies. How much of the recoveries are a result of legacy assets relative to legal recoveries?
This is Eugene Cheed, Mr. Hood, and I will take that question. So over the life of the program, all asset proceeds received have been utilized to satisfy the claims and expenses of the estates following the Regulation 709 payout priorities, including the recent distributions. The legal recoveries have provided net proceeds of $3.8 billion, has already been mentioned. In comparison, the NGN legacy assets have provided net proceeds of $32.2 billion. While the most recent distribution was materially funded by the recent sale of proceeds, the ability to make these distributions are a culmination of numerous past asset sales received and the claims paid over the life of the program. That concludes my answer.
Great, thank you, Eugene. And I'm just going to step aside for a moment and just note that I know it's customary for this board to welcome newcomers when they make their first presentation. I'm going to recognize you for being here for the longest because you've been a part of every action that's taken place at today's meeting. So you get the longevity award for board participation. Now shifting back. When the NCUA established the Corporate System Resolution Program in 2010, managing to the least long-term cost consistent with sound public policy was one of the core principles established by the NCUA board under the leadership of then Chairman Matz and Frizzell. I would just like to applaud them for that effort. They should certainly be proud of today's outcome. I know we all are, and again, I want to recognize them for their great leadership that they showed during that difficult time. But with any significant challenge, there are opportunities to learn lessons. One lesson I would take away from the failed corporates is patience in the resolution process. So I'm glad that we're going to do a look back at the failed corporates, not to second guess or question decisions, but to learn from this experience. As we all know in financial regulation, history can often repeat itself. I think a critical lesson, again, is patience during times of crisis. For example, I'm glad that this board showed great patience at my urging with a premium assessment based on the equity ratio last year. Since that time, we haven't been required to assess a premium under the law as the equity ratio has improved. As we think about the corporate resolution, there were costs to this liquidation, even if the liquidation was ultimately unavoidable. But I would say that the corporate system is no longer working in the same manner. After the crisis, the NCUA board revised Part 704, which placed greater limitations on the corporates. While the NCUA board had to do something, we should also acknowledge publicly that this really hurt the smallest of the credit unions. Prior to the corporate failures, smaller credit unions could put all of their investments in one corporate. They cannot do so today as the corporate system has entirely evolved, as today it primarily handles cash management and short-term investment and liquidity services, with longer-term investments being directed off balance sheet. It has become more difficult for smaller credit unions to compete based on this outcome. So shifting gears, can you discuss why no other corporate has been able to fill the void left by U.S. Central and access to the Central Liquidity Facility since its involuntary liquidation in 2010?
Yes, sir. This is Keith Morton, and I'll answer that question for you, Board Member Hood. U.S. Central was part of a then three-tiered credit union system where U.S. Central had 27 corporate credit union members that were materially reliant on them for financial and operational services at that time. As such, the unique size, structure, and role of U.S. Central allowed it to purchase the required CLF capital stack on behalf of all credit union members of corporates, allowing them access to the CLF as a source of liquidity. Today, post the corporate system resolution, there is no longer a single corporate like U.S. Central, and the remaining corporates are much smaller as they recognize the need to have a better balance of balance sheet against capital. It simply isn't economically practical and in many cases feasible for any one of the remaining retail corporates to step in and buy all of the capital stock on behalf of all eligible natural person credit unions. For one, a material number of natural person credit unions are larger than today's corporates. This impedes a corporate's ability to subscribe to the CLF stock on behalf of all its members, as is required by an agent under the statute. Furthermore, today's retail corporates would have to overcome the fact that they don't have a wholesale cooperative like U.S. Central to provide mutual scale to purchase the CLF stock. That concludes my answer, sir.
Great, thank you, Keith. I really appreciate that response. In closing, I want to thank you, Keith Morton, and your whole team. Keith, you are indeed the utmost and consummate professional who has my full trust and confidence. You've done yeoman's work managing these corporate estates. There is no way anyone could manage estates of this magnitude and satisfy everyone at the same time. But to quote Aristotle, as I am going to do, there's only one way to avoid criticism. That is, do nothing, say nothing, and be nothing. And I end that quote. So thank you, Keith, for your leadership and your willingness to make the hard decisions. I have no further questions or comments. Thank you. I yield back my time, Mr. Chairman.
Board Member Hood, very, very well said. I do appreciate that. And I also agree that we should learn from our experience and consider what changes we need to make to our policies going forward. And thank you to everyone who has joined us today. That is the end of today's agenda. There being no further business, we are hereby adjourned.